Good afternoon and welcome to today's ACAMS web seminar, Understanding the Impact of the FATF Revised Recommendations on Local Anti-Money Laundering. I am Carlene Mack, the web seminar producer at ACAMS. To begin today's web seminar, please allow me to introduce our panelists. Zia Ullah, Partner, Regulatory and Compliance Advisory at Pannone LLP. David Blackmore, Director, DB Risk and Compliance Services. Mark Dunn, Marketing Planning Manager at LexisNexis International Business Information Solutions. It is my pleasure to welcome our panelists. I will now turn it over to you, Mark, to begin today's web seminar.
Thank you, Carlene, and thank you for your patience. We did have some technical problems here getting this started, but we can now actually begin. The first speaker is Zia Ullah, who has many years of experience within the areas of anti-money laundering and tackling financial crime. And I'll hand over to Zia, who will begin by giving you an overview of the FATF recommendations.
Thank you very much, Mark and Carlene and ACAMS, and good morning, good afternoon and good evening to the attendees on today's webinar. And apologies again for any technical issues we had at the beginning of it. As a result, I think I would assume we've got a limited amount of time now. So if I was going to proceed fairly quickly prior to the technical difficulties, I think I'll be going a little bit quicker. So many apologies if I go too fast for any of you. Please feel free to ask any questions along the panel you can see on your screen as we go along. Mark, David and myself have agreed that we'll probably leave questions and Q&As to the end, but if there's anything specific that we think needs answering there and then, obviously we will come to it. So just literally a 2-second overview of who I am. I'm Head of Compliance Advisory at Pannone. I was formerly Global Head of Sanctions and Policy for Anti-Money Laundering Sanctions and Anti-Bribery and Corruption at Barclays, and I always like saying that I wasn't a lawyer for a while because people tend to like me more. So I'm just going to, as Mark said, trot through how and where the key changes to the FATF standards have been made, and I'm going to just focus on a few of those key changes in my time this afternoon, and then obviously David will be talking on the practical issues arising from those changes, and Mark focusing on a couple of those issues in a lot more detail than David and myself. So, I mean, the key changes to the standards have been very well publicised and documented, and for most of us, not a great deal of surprise within those changes. We see that there's continued focus on the risk-based approach and what that has meant and what that will mean in the future. Equal focus on, and I suppose the key issue for change in relation to transparency, on beneficial ownership of legal persons and legal arrangements. International cooperation between regulators and international bodies, and the operational standards that particular financial regulators are adopting. There is some focus on new threats and new policies, but in truth, those are probably familiar to most of us working in the regulated sector in any event. And a welcome revision of the terrorist financing standards to be amalgamated within the 40 recommendations themselves now, so we don't have this bizarre nomenclature of the special recommendations anymore. We now move forward with 40 combined recommendations and hopefully some clarification of obligations as well. So the key areas that I'm going to look at now start off with, I suppose, one of the bugbears of many within the regulated arena anyway, which is the predicate offences for money laundering. And the key change here to the standard has been that serious tax crimes, and serious needs to be underlined there, I think, serious tax crimes have been added to the list of predicate offences for money laundering. So it now brings the proceeds of tax crimes within the scope of the powers of authorities for use in money laundering investigations. Now, for many jurisdictions, that's going to be nothing new. So, for example, within the United Kingdom, we operate an all-crimes approach for predicate offences for money laundering. However, there are many jurisdictions that do not, and so there is going to need to be a consequential change in the legal and regulatory framework with respect to money laundering investigation and enforcement. A good example, I think, would be Switzerland, because of their differential between what they define as serious crimes and their requirement for a minimum of 3 years imprisonment before it becomes a predicate offence for money laundering. So there's going to be some changes across particular jurisdictions. Moving on from that to customary due diligence, the recommendations have sought to clarify some of the aspects of customer due diligence. In particular, the difference between the use of simplified due diligence, and in particular, the identification and verification of beneficial owners, where they've in fact set out a step-by-step process to how that should operate in the future. Now, I will talk at the end of my presentation a little bit about where the EU are on this particular aspect, in particular simplified due diligence, and it not meaning no due diligence. But I think what will be welcome is the continued focus on the utilisation of a risk-based approach when considering customary due diligence. That's something the private sector has been shouting out about for a long, long time. I don't yet think that the regulators and the prosecutors and enforcement authorities yet understand that concept particularly well, and still, I think, expect institutions, particularly regulated financial institutions, to operate to a much higher standard. So it'll be good to see some clarification across the board when it comes to due diligence. Moving on to the transparency of legal persons. So, as I mentioned, Mark will be going into some greater detail on this and on the transparency of the beneficial ownership of such and legal arrangements. But the key changes to the recommendations involve improving, and again, it's a bit of a woolly concept, but improving the transparency of legal persons, in particular by requiring basic information relating to legal persons, i.e. companies, LLPs, etc., their directors and shareholders, to be maintained, and also for a specific nominee directors and shareholders to disclose their status onto company registries or be licensed. And that's a key differential. So within the United Kingdom, again as an example, there is a requirement for those that operate such schemes to be licensed or registered with Her Majesty's Revenue and Customs, so already operating to an extent. But the United Kingdom is pretty low down in terms of those that are transparent in the public dissemination of that type of information. Certainly, we've got a bit of catching up to do in terms of providing that in a readily accessible format. So there's, again, one of the great bugbears for financial institutions are politically exposed persons, or PEPs. Now, it's not a surprise. There's been a lot of discussion about PEPs, particularly in the context of the United Kingdom of the Bribery Act, but also globally with the World Bank initiatives and OECD initiatives and Transparency International as well, focusing on PEPs and corruption. So it's not a surprise to see FATF moving the standards on from foreign politically exposed persons to also include, on a risk-based approach, domestic politically exposed persons and PEPs from international organisations. Now, many financial institutions already operate on the basis of no distinction, i.e. a PEP was a PEP, whether they were domestic or non-domestic. And I suppose from a practical perspective, and forgive me if I'm encroaching into any other territory, David, but from a practical perspective, it seemed to us when I was operating in a global bank that it was an artificial distinction to make, and from a practical perspective, it wasn't one we were prepared to make, because trying to differentiate between the two would have caused much more heartache on the ground. So for me, I think I would have liked to have seen the domestic PEP requirements fall into line with the foreign PEP requirements wholesale, rather than provide a distinction, which again gives us more room for grey than black and white, which is what financial institutions need in this day and age. Now, again, one unfortunate thing that we saw was the non-publication of PEP lists, and again, it would be good to see this from a practical perspective in the future. One of the things that I think this actually impacts small and medium-sized firms more greatly, who are lacking in resource, is to have a publicly available list of PEPs that all people could use, rather than having differentials across the board. And obviously, the definition of PEP still includes family members and close associates, which again causes great difficulties in terms of practical implementation. One of the other recommendations, and a new recommendation, is the applicability of UN targeted sanctions in relation to the financing or countering the financing of the proliferation of weapons of mass destruction. So we've previously seen the terrorism implementation being spelt out, but here we see financing of proliferation as a defined recommendation, and one would expect there not to be too great a challenge for countries to implement this particular requirement going forward. As I mentioned, the special recommendations have now been integrated, and that was I think an understanding and an awareness that actually, for those of us who operate in the financial services sector and regulated sector, it was an artificial distinction to draw between AML and terrorist finance, when in fact the measures being taken by institutions were conjoined and of the same type. There was no distinction drawn internally in relation to measures to be taken. So I think it's welcome to see that special recommendations are now absorbed into the one group of 40. There is further clarification given in the FATF recommendations on effective exchanges of information. I think, again, sometimes the language used within the recommendations can be a little bit difficult to penetrate, and it's sometimes difficult to know what they mean by effective exchanges of information. I think the purpose behind the recommendation is absolutely clear and necessary, and again, from an EU perspective, my experience has been that actually there's a lot of exchange of information at the international level between particular prosecutorial and investigative bodies such as the police and prosecution bodies as well. So it would, I think, in this sense, what would have been useful would have been an understanding of where that's actually fallen down in the past, so that people can see where they need to address resource going forward. And the same can be said for the improvement of operational standards with respect to that moving on. It's difficult to understand what in fact FATF is looking for when it puts forward these particular recommendations. Again, for those that operate in the sector, we sort of get a feeling for what they're trying to get at here. But it's not altogether clear from these standards as to what will be required of particular jurisdictions. And I suspect what we might see is that my reference 7 and 8, not recommendation 7 and 8, but my references to improving operational standards and exchange of information will be more drawn out on an individual mutual evaluation basis. Moving on to the requirements for financial groups, again, I think this is a very sensible development and has been updated, I think, on the back of the experience of regulators going in and finding that actually there's been not a conjoined approach to the obtaining of CDD across financial groups, and it's actually highlighted the differences across particular areas of function. So the EU is a prime example of that. So it's good to see this being implemented. My final focus in terms of the recommendations, and obviously these aren't the 40 in total. I just looked at some of the key ones that we're going to develop with David and Mark shortly. But the final one is transparency, and it's not a surprise here. It's something that's been spoken about and was contained within Special Recommendation 7 of the previous FATF recommendations in terms of wire transfer, cross-border wire transfer transparency, requiring originator and beneficiary information. And again, what we've seen here is a disparate approach. And again, I can use the example across the EU in particular, even though we have EU Regulation 1781 of 2006. Sorry to get technical with numbers, but just for those of you that are interested, we've had that in force now for 6 years. But it's clear to me, having been involved in some of these investigations, that not all financial institutions are regularly including this information, or if they are, there's a misunderstanding in some certain areas as to what information needs to be included on wire transfers. So again, it's good to see renewed focus on transparency of these wire transfers. Now, very, very quickly, because I'm encroaching on David and Mark's time, in relation to the impact of these changes on the prospective fourth European Union money laundering directive, well, we saw an in-depth review take place of how the third money laundering directive had been implemented across the European Union, and there are, again, many surprises. In fact, it was pretty much a good news story for the EU, and I think we could all do with some good news stories on the EU at the moment. This was one of them. People are implementing it to a greater degree and adopting a pretty risk-based approach to it. I think there are some technical issues about whether, in fact, people have misunderstood what simplified due diligence means in relation to the risk-based approach, and I think it's good to see that there's a focus on it, meaning that people have to do something in terms of due diligence, not nothing on a simplified basis. But it'd be good to see that drawn out in some greater clarity if we see a fourth EU money laundering directive. In terms of the scope, I think we don't expect there to be many changes in terms of the people it may apply to, just those sectors that have had a limited involvement to thus far, like the gambling sector, letting agents, etc. It's expanding in relation to what's going to be required of them. The approach and definition of politically exposed persons was going to fall into line with what the FATF have now recommended, and so too will beneficial ownership. So don't expect to see any changes with regards to the 25% threshold for beneficial ownership within the EU. And there may well be, although given the amount of briefing that's going on behind the scenes, the extent to which the directive is extended further to legal professionals has been something that I know that the regulated financial institutions have been shouting out about, and so the supervisors, but whether in fact there's a wholesale extension to legal professionals, I would doubt very much. So that's all I wanted to say on the changes to the FATF recommendations. Happy to take questions after David and Mark have finished, and over to you, David.
Zia, thank you very much. I think in the interest of time and in the fact we might get cut off in 20 minutes, I don't propose to go into very much more of the details. I put on the screen there the objectives of this review of the Financial Action Task Force's recommendations and what it aims to enable countries to do, which are all, a bit like motherhood and apple pie, are all very welcome, much more difficult in practice, as we certainly found in the UK and in the EU, to implement a risk-based approach. Personally, I think one of the risks of globalizing this is it is quite possible for a wide variety of risk assessments to be made by national governments, and groups, particularly within the EU, as we saw a number of historic compromises. For example, in the UK, we've had a risk-based approach since 2006, which was a whole year before the directive, or third directive, was implemented, and yet it is not 100% risk assessment, because it has been decreed that in certain categories, that's correspondent banking, dealing with PEPs, and non-face-to-face relationships, are automatically high risk, and therefore enhanced due diligence should apply, without any indication of exactly what enhanced really actually means. So to make this work, particularly in those areas of the world which either have a federal system of government, which means at the top level, this has to be distilled down to state or local level, but in any event, I would suggest it does need to lead to the creation and maintenance of a new compliance culture, where the exercise of judgment replaces what we all know as a tick box approach. This often in the past would seem to follow the system of government in certain jurisdictions. For example, a slightly more authoritarian structure lends itself more to a box-ticking approach where detailed rules are promulgated and enforced. Risk-based really does mean the exercise of judgment. And given the obligation for groups operating cross-border, they're going to have a much bigger challenge in order to make sure that this actually is the reality. And I think FATF will have their work cut out in order to make this absolutely a reality, given the relatively short timescale which we've all got to do this. Now, I'm aware that only yesterday the European Commission met a number of the banking federations in Europe with a view to finalising the drafting of the fourth EU directive, which cannot come soon enough, mainly because FATF are going to start enforcing their new standards and recommendations from the end of 2013. So time is not on our side. What, therefore, can we do in the interim? I think we can certainly move some ways forward on the implementation of counter-proliferation and international financial sanctions. I think that is common sense and ought to involve most, if not all, jurisdictions. The abuse of non-profit organisations too, I've given you there the recommendation. I think not enough has been done on this area, and we may well need to look at our customer bases with a new critical eye. Similarly, as my colleagues here was mentioning about the revised definition of PEPs, I have to say I've always found that distinction between domestic and non-domestic PEPs to be an absolute fiction, and I'm very glad that FATF is putting it right at last. Inclusion of tax crimes, well, again, the UK experience is somewhat problematical, but I'm glad it's happening, and we'll do what we can to assist in the practical implications of that. So what I mean by that is that the size of the challenge, I think, is significantly greater because of the top priority for many jurisdictions, which is the financing of terrorism, and indeed understanding of what we actually regard in our jurisdictions, wherever we may be, of what terrorism actually is. So certainly we'll need certainties from government, both on a regional, for example, an EU basis, as well as for individual jurisdictions. And I would just mention here that cybercrime, which I hope will get fully discussed before the fourth European Union directive is put in final form, particularly given the timescale, that it's important that we have the implications of cybercrime both for the commission of terrorism as a facilitator for other financial crime, hacktivism, and of course the major issues of national security and espionage. It's all over the UK papers today about our director of MI5 who's extremely worried about the new directions of terrorism, and we will be, I think, paying much more attention to the implications of the recommendations and hopefully drafting group-wide policies which will need, let's say, a given level of authority in order to apply it at the local level, particularly for global firms. So, where does that leave firms? In my view, I think the first thing to do, really, which we can do long before this becomes law in our jurisdictions, is actually do a gap analysis to the recommendations. It ought to be documented. On the back of that, we ought to be reviewing our individual firms' risk assessments, mainly because everything else stems from that risk assessment. So, is it up to date? Have the risks to our firms changed? Do we make sure we include new products, services, local law and regulation, and of course take into account the impact of the current economic climate and global market turbulence? On the back of that, I think none of this is actually going to work unless and until senior management, that's boards of directors and our senior management colleagues, actually own and drive the process. Because a risk-based approach is not by any means a soft option. To evidence that, we need to make sure that policies and procedures, handbooks or manuals, whatever you use, intranets are actually fit for purpose. Does our monitoring program accurately target the higher risk areas that we've identified? And how do we demonstrate the ongoing effectiveness of our risk-based approach? For example, in the UK, our regulator requires an annual report by the Money Laundering Reporting Officer. I would suggest that's a very good idea in order to ensure that we have consistency of approach and to make sure that for groups that operate cross-border, that they can demonstrate they have what is known as an holistic approach to financial crime. In other words, we don't separate anti-money laundering, countering terrorist finance, separately from fraud, insider dealing, market abuse, etc., etc. And so that's really a very quick take on some of the practical things that I think should be important in the short run up to the implementation of these recommendations and hopefully going forward.
Thank you, David. I'll finish the presentation today just by focusing on one specific aspect of the recommendations, and this is around transparency and beneficial ownership. And hopefully the recommendations do actually bring some relief for AML practitioners by trying to encourage government to provide publicly access to beneficial ownership information. Because we all know that it's no secret that this is a major problem firms are dealing with, and there have been many reports over the years looking at this issue, looking at how beneficial ownership data can be collected and made available to AML practitioners. And there's a series of quotes on the screen there that reflect some of the work that's been done as long ago as 2001 and even further back than that, really emphasizing how big a problem this is and how few jurisdictions actually do collect this data. So as I said, it's not new. The issue has been looked at many times. I mean, as far back as 1988, when the risks between beneficial ownership and financial crime first started to be focused on, there have been multiple reports, multiple recommendations from various government and other agencies, but so far nothing has been done to provide the AML practitioners with access to good quality and up-to-date beneficial ownership data. So looking at that problem in a little bit more detail, as an example, there was a report from earlier this year from the European Securities, or rather supervisory authorities, which essentially is made up of a number of different regulatory bodies across Europe, and they looked at the availability of beneficial ownership data for different corporate vehicles in Europe, just as an example as to how difficult this problem is for people trying to conduct customer due diligence on this problem. And just to give you some examples of what they found, there were many countries that didn't provide this. Here's an example of countries where this is not available for foundations. There are examples for legal entities other than foundations, for example, where many countries aren't collecting this data on beneficial ownership. You have various legal arrangements like trusts, etc., which again, many countries don't collect or have an unclear policy on dealing with this content. And again, further examples as well illustrating that. So it's very clear from this report, amongst other reports, that there is a real dearth of information available to help people tackle this problem. So essentially, if we go back and look at how big a problem this is, I mean, going beyond Europe, obviously, if you're dealing with, in most cases, enhanced due diligence on more high-risk entities, you can see the extent of the problem here. So very clearly, looking at, obviously, the growth areas, the emerging markets in the top graphic there that we all want to be in and we're all investing in, and we're all dealing with third parties and customers in those markets. But unfortunately, Transparency International, their Corruption Perceptions Index, obviously doesn't really rate many of those countries very highly in terms of how they're tackling bribery and corruption and other issues locally. So this makes the problem even worse. I mean, firstly, we can't get beneficial ownership data in some of the more established jurisdictions, perhaps, and this problem is obviously magnified when we're trying to conduct due diligence in perhaps other markets deemed a higher risk. So in terms of what this means, the customers we speak to are obviously trying to tackle this in many different ways, depending on the risk they're dealing with and the extent of wealth or other factors involved. That may simply be trying to search the web and use different company registrars to try and find out what they can, or it may be actually employing outsourced advisors to go and look for them and conduct investigations on the ground. You know, there's no simple answer because this data just isn't readily available. So what it brings us to is a little bit of positive news. If we go back and look at what the OECD did on this subject, they basically recommended 3 ways governments should consider to tackle this problem. One is to improve upfront disclosure, so to actually get companies to file this data when they're registered and to keep that data up to date. Another is to actually use intermediaries to collect this information, whether they be company registrars and register agents, people like that. And another may be to actually strengthen the investigative system within a jurisdiction to enable that data to be readily available. But the good news is, I guess, getting back to the recommendations, is that the FATF is really pushing for the first option there, to encourage upfront disclosure. And if we turn to the recommendations in the final slides, you can see recommendation 24. I won't obviously read all the text, but essentially the point here is that the FATF is really encouraging the collection of that data. And again in recommendation 25. Now both of these recommendations have appeared before in earlier versions of the FATF recommendations. They were just labelled differently in the past. But the main difference, and the good news hopefully for AML practitioners, are the accompanying notes to those recommendations. So the FATF really is trying to spell it out to make it very clear for jurisdictions that they expect to actually go out and get this data and make it available. Okay, so they're really trying the best they can to encourage this behaviour within the different local markets that are adopting these recommendations in local law. So you can see the emphasis there on being able to obtain and record basic and beneficial ownership information, make the above information publicly available, etc. And then going on to spell that out even further by giving the jurisdictions 3 options to consider to actually do that. So to use company registrars and company registers to actually collect that, to actually use other means to actually collect up-to-date information, so the companies themselves, so it's available when requested, or to look at existing information that may be available. And that's the one concern about these recommendations. Unfortunately, option C could be perceived by some jurisdictions as an opt-out. They may consider that they've already got existing information and it's good enough and it satisfies the need of customer due diligence. Hopefully, the FATF will be conscious of that and obviously be looking closely at how different governments apply these recommendations and the availability of that kind of content. So that's the one thing I wanted to focus on. It is a specific part of what's come from the FATF, but it is important to all of the practitioners we speak to, and hopefully, once and for all, we will see a solution to this long-term problem.
Mark, if I could just pop in our remaining time, I think one thing that all of us are hoping to guard, or hoping the authorities will guard against, is gold plating these recommendations when it comes to legal structures. For example, the proposed EU fourth directive, at first sight, from what we know of it, is in direct conflict with the one they proposed a year ago on data protection. And this ties in with very much what Mark said. So there's an inherent conflict here, and what we don't want national authorities to do, because firms need certainties, is to gold plate things, and in the interest of, quote, harmonisation, unquote, nullify the real effect of a risk-based approach.
Okay, we have one question that's come in. When will the FATF recommendations take effect? And I think we may have mentioned that during the course of the call, but I don't know if you want to just reiterate that fact, David.
Yeah, in the press release from the European Commission, when this was released, the FATF made it plain that they will be doing mutual evaluations from the beginning of 2013. Sorry, the end of 2013. So, we're already halfway through 2012, legislators globally have 18 months to get their act together, which is a tall order, in order to implement this at local level.
Okay, there's one other question that's come in regarding ultimate beneficial owners. Just looking at that now. So I've seen financial institutions simply dump unverified or undated ownership into their systems from information providers, rather than actually go to the registers and get today's information today. I think that's a fair point. I think what we've seen generally, the way customers are approaching this, firstly, they're asking their clients to provide the beneficial ownership data because they can't identify that information themselves. It just isn't available. So they're asking customers to actually provide that information as part of the onboarding process. And then they're using any means possible to verify the information they've been given by their client. So as I said earlier, depending on the risk involved, that may involve a web check, it might be an online database, or it may even involve actually deploying an outsourced risk advisor to go and investigate that business. We don't often see the institutions we work with just taking what's read from their clients as beneficial ownership. They do put a lot of work in to verify what they've been told, but the verification is obviously very difficult because they can't just go and access that information publicly. They've got to use a whole series of different sources to try and interpret what they've been told and verify that.
One thing, folks, another question has come in about how long a person should be treated as a PEP after leaving or retiring from their previous position. Well, this is, in my view, this is one of the key issues of a risk-based approach. For example, in the EU third directive and UK legislation, it's a minimum of 12 months. But when you reflect upon the rather long period of time it took to unveil certain former potentates and heads of state, then I think a period of 12 months is probably far too short. There is a school of thought which says once a PEP, always a PEP. Personally, I would tend to back that general approach.
Yeah. Okay, any other questions that have come in? I don't know if you have any, Carleen, that you've seen.
No, I have not seen any other questions coming in. Okay, one just came in.
Yes, we have one here. Is there going to be any sort of provision for how press checks, especially on people with common names, are conducted and dealing with false positives? Yeah, I think this is an interesting question. So this really involves areas like searching for individuals in things like negative news content or general media content. to look for potential reputational risks in the press. It's difficult in searching that content to really apply too much of a structured process to that. I mean, for example, there are ways of indexing that data and applying keywords and key subjects. But often when people are looking at press content, they do want to try and cast the net wide and see what they can find. You know, they want to be able to pick up small references to a name, maybe a passing mention of a company perhaps in the context of another business that's being talked about. So we found from our experience that with our features for negative news, we do keep those very broad and enable users to firstly tailor the negative news search as to how they see fit, and then to actually either narrow the search when they've got results, or use some of the other connectors or search logic we have if they need to.
Just one small thing on that. I hope we've got time. I think it's an extremely important question. I'd only say from the UK angle, we've recently had some pretty vigorous enforcement against financial institutions which do not use open source intelligence, and then if they do have it, they don't actually act on it. So I think this is another thing that at the national level we ought to be encouraging, should I say, to make sure that firms do use all the resource at their disposal, which these days does, of course, include open source IT. Lots of this is not 100% factual truth, but it may give cause for concern where we want to carry out further inquiry before we're really happy that we actually are dealing with an entity which is what it says it is. And that's really at the basis. This is not, in my view, rocket science. You know, we have to be satisfied whose funds we're dealing with, where they come from, what's the purpose of a relationship, all of these things which we get cumulative assurance on before we open a relationship.
Yeah, am I still audible?
Yep, go on.
I was just going to say, I agree with that, David and Mark. I think one of the issues that is often forgotten and overlooked, and I think it links back to Patrick's question, and I think there's an earlier question regarding simplified due diligence that we might have just gone over. I think that the whole purpose of doing these checks is often overlooked by institutions. They just take the approach that David alluded to, the tick box approach of I need to get this information, I need to get that information, and therefore my job is complete. When in fact it's not. What people often forget is the whole purpose behind why this information is being sought. It's not being sought to try and make your or my life more difficult, although oftentimes it does. It's being done to ensure that we are not opening or conducting transactions, opening accounts for those people that are sanctioned, for those people that are conducting money laundering or trying to obtain or transact with terrorist finances, whatever it might be. But that's the ultimate reason behind these requirements. And so I think David's absolutely right, and Mark, when he spoke about the fact that actually a wider net as you can cast in relation to that information gives you the best opportunity to understand who it is and whether it's the person you're thinking of. I can understand the reason for the question, and oftentimes it throws up more questions for you than answers, but actually that's a better way to progress your ultimate aim, which is to ensure that your institution is protected.
Folks, we're just having one or two questions, and we hope that everybody's still with us, which is great news. We've just got a question in, firstly, about sanctions. Is Syria sanctions applied by all banks in the EU? Well, in theory, once the European Union has decided on a sanction on any entity, whether it's Syria or anywhere else, then all member states are required to apply it. I think the difference comes because the EU has no powers of enforcement, and so that requires local legislation, and in the UK it's a statutory instrument which applies sanctions for non-compliance. So in theory, the short answer to the question is yes, but as I'm sure the questioner knows, this is a developing situation, and that's what makes the FATF recommendations on sanctions such a crucial issue, because flexibility is needed. In many cases, the sanction regime is not risk-based, but in many cases, how we cross-check our entire database against a fast-moving international diplomatic environment is, of course, one where some risk-based approach can possibly be applied. But it's all very important to make sure that domestic legislation does enable that to happen. Because in the UK, for example, it's a discrete legal regime. We don't have a risk-based approach to sanctions. Another question, we're rushing this, so I hope folks can still hear us. Can you give some more information about government-approved NGOs, as they too are higher-risk entities, and how do we find the exact beneficiary for such entities sending and receiving monies? Well, Mark, I think Mark's hit this already. You have to go as far as you possibly can to the people that run the show. It's the same as corporate entities and trusts. Yes, of course, it's quite okay to ask the client. Then you need to use other sources, their website, their connections, and in most jurisdictions that I'm aware of, trustees, beneficial owners, signatories are all those that we would want to put through the sanctions and PEP screening, and really why they are government-approved NGOs, what their role is in that particular jurisdiction. I assume you're not meaning charities here, because that's a separate section, a separate sector. Don't know whether Mark's got anything further to say, or Zia?
No, I actually assumed that they were talking about charities.
Charities. Oh, right.
So I was probably wrong in that assumption. But I think I'd agree with what you said. And I mean, charities is a good example anyway, because certainly in the UK, obviously, we've got the Charities Commission which oversees it, and oftentimes provides a list of who those registered NGOs stroke charities are. I think the difficulty, as Mark alluded to earlier on, the difficulty is the extent to which you can get underlying information about the trustees from publicly available information.
Agreed. We've also got a question which Mark and I are puzzling over about the difference between a rep and a PEP.
PEP, rather, yeah. I don't know whether you're familiar with those terms, Zia. So a rep and a PEP.
I can't see the question. Sorry, where's that? I haven't seen it.
Yeah, somebody's asking, what's the difference between a rep and a FEP? So FEP and REP.
I don't know what an REP is. What's an REP?
I wish we knew. It just goes to show nobody has 100% knowledge on this thorny issue.
Yeah. Well, let's move on to maybe one final question. We've got a question here about, is there a movement to lower the beneficial owner threshold from 25% to 5%? It'd be interesting to see what our panel says about that. I mean, personally, I've not seen that, but because
I don't, as I mentioned in at the end of my talk, certainly within the EU, I don't think there will be. It certainly would be a surprise to see any movement away from the 25% threshold for beneficial ownership. I think that's different from whether, in fact, institutions within the EU in particular actually have within their own requirements a differing threshold, and I certainly know of several large financial institutions that operate their beneficial ownership thresholds at around 10% rather than 25%. So from a regulatory perspective, will we expect to see a lowering? Probably not. I think the difficulty is that any large-scale institutions that do change or do have a differing approach to beneficial ownership often change the goalposts in terms of regulatory expectation, even though there is no strict regulatory requirement to do so. So what you find is that if you are in the same jurisdiction as an entity that is operating a lower threshold, you might find your regulator or supervisor asking you the question why you don't adopt the same approach. So oftentimes that sort of information is crucial to obtain amongst participant groups to see whether there is an underlying expectation of operation at a lower level.
Folks, I'd agree with that insofar as with a risk-based approach, the 25% is always, in many ways, an operational guideline. Yes, okay, it's going to be written in law, but that does not mean you ignore somebody with 22% if there are other reasons for concern. It's all about control. You can control an entity and a trust or any other corporate entity, for that matter, with far less than 25%. And criminals and corrupt officials, heads of state, the world over know this intimately, which is why they've been getting away with it for so long. So it's the common sense approach. Yeah, 25% in law. The real issue is, do you know who owns and controls the entity which seeks to do business with you?
Yeah. I think maybe just one more question, actually, because this is something that Zia mentioned, and it's something that does come up quite frequently. Do you foresee PEPs as being something that will tend towards a list strategy akin to an OFAC SDN list? So basically, I guess what the inquirer is asking here is there going to be a publicly available list of PEPs that everyone can use and refer to? Now, unfortunately, I don't think there is. I mean, we've had the CIA list out there for some time now, really being put forward as the only list available publicly that seems to cover high-profile individuals. But there's nothing that's really been published that complements that. And I know government, certainly in the UK market, the government has been asked several times at different conferences about whether they will step forward and start putting together a PEP list for AML practitioners, and they've declined every time. They just don't see it as something that they should be focused on. And I guess the issue here is that even if governments did provide lists of PEPs, the real value for investigators and practitioners is obviously being able to see the linkages between these individuals. So not just finding a list of names, but also what the associations are, what the different connections are between these people. And I can't see a government agency being involved in effectively becoming a database vendor, taking on a PEP database where they've not only got to maintain the content, but also maintain the complexity of linkages and associations. So I guess the short answer is I don't see a PEP database becoming available in the public domain free of charge to everybody anytime soon. There just doesn't seem to be the appetite from government to do that.
We've also got a couple of questions come in from colleagues, I guess they might be in the States, to do with FATCA. And one of them, can you put that up a bit? In connection with the application of a possible 10% substantial ownership threshold. Well, that's quite likely, and I do think actually FATCA does have a significant influence going forward on due diligence inquiries, because the two subjects are linked, which is why I'm arguing very strongly for an holistic approach within firms to make sure that the intelligence you gather for one purpose is shareable with others for anti-financial crime reasons. And I thank them for those questions. It's going to come up big time because, as many people know, FATCA does have extraterritorial effect and will be quite significant certainly for wealth management and private banking firms.
Okay, well, I think that pretty much brings us to the end of the session. And apologies again to those who were here at the beginning who had quite a number of technical problems we had to contend with getting this session up and running, but I hope it has been useful. I believe the presentation is going to be available after the session for your reference. And thanks again for your time, and no doubt we'll see you in the future. Thanks very much.
Before we wrap up, on behalf of ACAMS, I'd like to once again thank our panelists, Mark, David, and Zia, and the audience for joining us today and sending in your questions. If you have suggestions for future web seminars or questions for today's panelists, please send those to training@acams.org. Also, we appreciate your feedback, so please take a few minutes to complete the survey that will appear in your browser at the end of the web seminar. That concludes our web seminar. Thank you, and have a good afternoon.